We always pride ourselves in staying ahead of the curve. We don't just tell you what happened, we tell you what's going to happen, which is obviously more valuable to investors. The entire international monetary system isn't driven by the Fed, but by Eurodollars, the money that banks lend to each other to support their balance sheets and lend to customers or offer transactions to customers. The main transactions, the 800 LB gorilla, if you will, involve approximately $1 quadrillion in derivatives options, futures, forwards, swaps, swaptions. For those unfamiliar, a quadrillion is 1,000 trillion. Nearly all of this must be backed by collateral. Consider a hedge fund calling Morgan Stanley for a $5 billion total return equity swap. The hedge fund can buy and sell stocks all day up to $5 billion notionally, without owning the stocks. Morgan Stanley, in turn, might buy the stocks to hedge its position, but will require collateral from the hedge fund. The hedge fund doesn't need to provide $5 billion worth of collateral, but enough to cover mark-to-market losses. Collateral is the key to the entire quadrillion-dollar structure. Good collateral today is increasingly scarce. Banks are growing suspicious of each other's credit. Early signs of a global liquidity crisis, different from a recession or a plain vanilla financial crisis. They now prefer treasury notes, especially short-term ones like 6-month bills, 4-week bills, or 30-day bills over corporates or mortgages. This creates a scarcity and drives banks to bid for treasury bills at yields lower than what the Fed offers, highlighting a desperate need for these bills as collateral. To acquire these bills, banks need dollars. Hence, there's a massive bid for dollars to buy treasury securities to support balance sheets. This underpins the strong dollar despite weakest economic fundamentals, recession, long-term depression, deficits, political dysfunction. Historically, the dollar has maintained confidence despite the absence of the gold standard, thanks to good management and periods of strong growth. However, today's confidence is eroding. As banks reduce balance sheets, a major player could go bankrupt, leading to a situation akin to 2008, but potentially worse, exacerbated by energy shortages, supply chain breakdowns, and higher fuel prices. From the supply side, inflation is driven by bottlenecks and higher costs. Demand pull inflation is psychological. Consumers buy now to avoid higher future prices, pulling demand forward and validating price increases. The Fed can't control supply-side inflation, they don't drill for oil or drive trucks. But they can destroy demand by raising interest rates, which slows down the economy and leads to recession. Recession and depression differ significantly. A recession is identified by 2 consecutive quarters of declining GDP, while a depression involves prolonged, below-trend growth, often with intermittent periods of growth. Since 2007, the U.S. has arguably been in a depression, with growth persistently below potential, leading to lost wealth. Despite massive deficits and high debt-to-GDP ratios, the dollar remains strong due to a global shortage. The Fed's creation of base money hasn't entered the real economy, but has stayed as excess reserves with banks. Inflation is driven by supply shocks and fiscal policy, trillions in deficit spending acting as helicopter money, unlike the Fed's monetary policy, which hasn't caused inflation directly. In summary, the financial landscape is complex and fraught with risks. Understanding the mechanics behind the scenes, from collateral requirements in derivatives markets to the Fed's monetary policies and global dollar shortages, is crucial for investors navigating these turbulent times. Handout checks, that's helicopter money. That's money that goes directly to consumers and businesses. It's spent immediately and enters the real economy, driving up demand and prices. This fiscal policy is a major driver of the current inflation, not the Federal Reserve's balance sheet expansion, which primarily stays within the banking system and doesn't directly impact consumer prices. To sum up, we're in a complex and precarious economic situation. The global financial system is heavily reliant on the US dollar and US Treasury securities as collateral for an immense amount of derivatives and other financial transactions. This creates a constant demand for dollars and Treasury bills, even when the fundamentals of the US economy appear weak. Meanwhile, supply chain disruptions and expansive fiscal policies have driven up inflation. While the Federal Reserve's monetary policy tools are limited in addressing these supply-side issues, the Fed can only influence the demand side by raising interest rates, which risks pushing the economy into a recession. Moreover, the political dynamics and the actions of the Federal Reserve add another layer of complexity. The Fed's actions, driven by a need to curb inflation, might inadvertently exacerbate a global liquidity crisis. As banks seek the highest quality collateral, they face a scarcity of short-term treasury bills, intensifying the demand for dollars and pushing the dollar's value higher, despite the domestic economic weaknesses. In essence, the global financial system's reliance on the dollar and treasury securities, combined with current economic policies and conditions, has created a situation where the dollar remains strong due to external financial system demands rather than domestic economic strength. This divergence poses significant risks, including the potential for major financial institutions to face distress, leading to scenarios reminiscent of the 2008 financial crisis, but potentially more severe due to the intertwined global financial dependencies and current geopolitical tensions.